Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carrillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carrillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carrillo. Today we have Alina Trigub. Alina is the founder and managing partner of SAMO Financial, a private equity real estate investment firm. She hosts 2 meetup groups in New York and New Jersey and has helped her investors invest in over 1,200 apartments, over $10 million in self-storage complexes, and over $5 million in mobile home parks. So how are you doing this morning?
Doing great, Charles. Thank you so much for having me on your show. I'm really excited to be sharing some words of wisdom with the audience.
Yeah, I appreciate it. Thank you very much. It's great to have someone that's very experienced in, usually we'll get someone that's in one of the asset classes, but since you've put investors together and deals together in multiple asset classes, it's great to be able to kind of pick your brain a little bit as we kind of go through these. So, Alina, give us a little professional background on yourself prior to starting in SAMO Financial and starting to invest in real estate.
Absolutely. So my background is in accounting. I started out as a tax accountant many years ago in Big Four. I was with Ernst & Young, but never really enjoyed doing accounting and taxes. So after trying public and private, I decided to switch. And I switched to technology world. So it was a completely different switch. And my roles have been within technology world for the last 18 years, but more or less about being a liaison connecting business and technology worlds. And I like that experience. It's great. But I was always, number one, fascinated with real estate. And number two, as a former tax accountant, taxes has always been in the back of my mind. I was always thinking, how can I lower taxes for a family? How can I lower the AMT? Because AMT, alternative minimum tax, has always been a problem. And I thought that there should be a way to connect my passion for real estate and minimizing taxes. So I started researching. Wanted to buy something locally where I live. It's a tri-state, New York, New Jersey. That turned out to be a challenge as the prices and the taxes are extremely high in this area. So that did not turn out so well in the sense that I didn't buy anything locally. However, that pushed me to start researching long distance investing, and that's how I came across the world of syndication. So after doing additional research on private placements, I decided to take action and started investing as an equity partner, which is passive investor myself. And after doing investing in a number of offerings, I realized the tremendous benefits of, number one, being passive, number two, tax advantages, as number three, social aspect of it, because in a way we were going into community and putting our efforts into improving the community and helping local folks to get a better place to live, having parks, maybe pet parks, and just better home conditions. So it was tremendous impact. And I decided that I need to bring it to the market. It's not something well advertised or well known by the folks in the community, and that helped the idea of my own company, SAMO Financial, to be born with the sole purpose of helping others to build their wealth, not only through Wall Street stuff, which everyone's already doing through their 401ks or IRAs, but help them diversify even further outside of Wall Street into real estate, which is the area that offers a lot of more calculated risks, if you will, where Wall Street is strictly throwing a dart in the dark in my sense. So that's how I got started in real estate.
That's awesome. So normally when we have someone on the show, it's like multifamily is usually the biggest thing. So there's, it's easy to find investors for that. It's easy to get financing. I'm very interested in, from self-storage, mobile home parks. and apartments. What is your favorite asset class of those?
Sure. So the favorite asset class depends on each individual deal. I wouldn't say that one or the other is more favorite than the other asset class. So when we select a particular asset class, we also look at the market, the demographics, market conditions, and what the deal itself offers. Like, for example, for mobile home parks, there are specific states that we would only go to buy mobile home parks. And for instance, Arizona or the Carolinas would be some of those states where we would go. But again, the market conditions for that local area have to be favorable for the asset class for us to even consider it. And then we look at the offering itself. So to answer your question, I don't favor one asset class over the other. I really like them all. But what I did do is I also started with multifamily, just like a lot of other folks. But gradually, as I progressed in my research and as I realized the demand for further diversification for myself and my clients, I started research on additional asset classes, one at a time, to determine which ones to add to our portfolio. I'm doing that now as well, looking at other asset classes. But it's, the idea is do the research on one thing at a time to make sure you really understand how the asset works and how it performs in the different market conditions. And that's what I did as well.
How does it differ in regards to risk versus returns for the different asset classes? Are returns pretty similar between those different asset classes? And one more thing too is, since I've not, it's how does if we have a pullback, how does that differ in between, say, self-storage and mobile home parks? How does
Sure. So in terms of the returns, they're more or less similar. Self-storage and mobile home parks tend to be a little more recession resistant, and that's what the research from prior recessions shows. And with storage, I guess it's more or less a given. People understand that, unfortunately, during recessions, a lot of folks lose their jobs and they need to downsize. So the first step that they take when they downsize, they gather all their belongings that they don't want to give away or sell, and they put them in a storage for undetermined duration of time. And at a time, that duration becomes permanent and they continue paying for the storage. So the storage tends to perform even slightly better during the recession times. In terms of mobile homes, so our strategy is not to go into the extremes, which means that we're not going to really poor neighborhoods, and we don't really go into luxury, like the newest, freshly built mobile home parks. We go into so-called bread and butter, into those B and C areas where we know that the workforce housing type of people that live in mobile homes because the area around them does not allow them to afford living in an apartment. It's just too expensive. And that's why they choose mobile homes. But in a lot of cases, they buy those mobile homes, so they become mobile home parks owners. And, as a owner of a property, you want to make sure that it's a pride of ownership. So a lot of people, once they buy them, they renovate them, they beautify them, and, make those mobile homes look as pretty as possible, because that's something they own and they live in there for a long time. So that helps us as a park owners as well when the mobile homes are well maintained by their owners, and we do tend to favor those. And even if they're not owned originally by the mobile home park, by the mobile home owners, what we try to do is we try to offer lease to own with different options. So the tenant would at least consider buying it in the long run, and we help them with financing options and so forth to get to that point. I don't know if I answered fully your question, but I think I did.
Yeah, no, of course. I mean, it's very interesting. There's kind of a different, with the mobile home park, as I understand it, and I've spoken to operators that specialize in them, and it's always, if someone's unable to, they lose their house, Going to a mobile home park is the next most similar but less
Correct.
expensive option because you still are not connected to anybody else. You still have the pride of ownership if it is your own trailer. And I speak to other operators and they say that the whole goal is not to own any of the trailers, but also to get the ownership to the tenants as fast as possible. Is that true?
Yeah.
So you're not like running a D-class apartment complex?
Correct. Yeah. You try to get the owners to buy those mobile homes as soon as possible. And again, it benefits both the mobile home park owner and the tenants, because the tenants become the proud owners of a property, and the mobile home park owner has a lot less expenses. So that lowers the expenses tremendously. And, maybe the overall bottom line is slightly over because now you're charging for the pad itself. You're not charging for the mobile home. But again, it lowers your maintenance expenses tremendously as well. So you have a lot less maintenance to care about, and ratio-wise, your income becomes exponentially higher in that respect.
Yeah, that's great. Now, you were mentioned the Carolinas and Arizona. Are your markets that you focus on for any type of purchases is all very similar? I imagine Southeast and Midwest. Is that kind of where you guys are targeting?
More or less. Yeah, we don't try to target same market for different asset classes. For us, again, the priority is that the market itself favors the asset class and works well for a specific asset class. So that's number one priority. But then we look at the overall market conditions and how the specific asset class had performed historically in a particular area.
Okay. Awesome. So investors that invest with your firm are considered like limited partners or passive investors.
Right.
Someone that's never invested passively into real estate. Explain how that works and what kind of the process and what their responsibility is once they've chosen an investment vehicle.
Absolutely. So for someone who has never invested in real estate, the path to start investing is slightly longer because I push them to get educated. I send them the educational materials. I recommend books, podcasts. I've written a number of articles to help people get acclimated with the terms, with the overall process. And I typically try to write my articles around the questions that come from my existing investor audience, and that helps to cater to the new folks as well. But my primary goal to make sure that whoever starts investing with us has a full understanding of what they're doing and only taking action after realizing the pros and cons of the investing, and then fully understands that these investments are not FDIC insured and hence that there are risks involved. I want folks to know that, when they see the projections, these are just that. These are just projections. Nothing is guaranteed. So the risk is still there. It's just the risk with private placements is calculated, where the risk with other investments could be more or less, throw in the dark in the dark. And that's why it's, there's a much higher risk in that case.
Yeah. Now, all of your investments are targeted toward accredited investors. Is that correct?
Majority of the investments are for accredited. We do have some offerings for sophisticated, non-accredited investors, but there are fewer far in between. Correct.
And just to explain for anybody, it's accredited investor, $1 million net worth, or as a couple, they're making $300,000 a year, and into the future, they believe they'll make that as well. So.
Right. And that net worth excludes primary residence. So for folks living in California or New York, your home, your condo may cost over $1 million, but that's not included. So you need to have a net worth outside of your primary residence.
With those investments that are accredited, because I guess you can speak, how does it really work with investment term, the returns? Do you do quarterly, monthly distributions? I mean, what's normal with the operators that you partner with?
Sure. Typically, I would say majority, at least 80% of the operators prefer to do quarterly returns. And nowadays, we tend to do everything through the wire. So we try to shy away from sending the physical checks. In the past, it was more common, but now it's also a matter of convenience. It's a lot easier to send them directly to the bank accounts. Some do monthly, but it's just a lot more overhead, and we try to stay away from that as much as possible.
Now, with your background being a CPA, and I imagine you get a ton of deals that come in and you probably cherry pick the ones that make the best sense, right? Less risk with the highest reward. What do you do when you're reviewing a deal? Like what makes you say, this is something that I want to bring to my group of investors, and this one is just not gonna do it?
Sure, Charles, and I want to make a small correction.
Yeah.
I was never a CPA, was an accountant, but not a CPA. But anyway, nevertheless, I still do review the deals. I definitely evaluate the underwriting that's done. I don't necessarily look for mistakes, but I look how underwriting is done and whether it's done conservatively in my eyes. I want to make sure that we don't just go with what the market expectations are, but we try to put the cushion in. And what I mean by that is, if let's say the market dictates that rents should be bumped by 5% every single year, I want to see 3% rent bumps. And the same applies for expenses. If the market says that the expenses should be bumped by 5% every year, I want to see 7 to 10% bumps in the expenses to make sure we have cushion on both sides. That's important. I also want to see the breakdown, not by year, but I want to see the breakdown monthly, because that gives you a more detailed picture as to what may happen month by month. You may decide to have a capital event, let's say at month 23 or month 21, and I want to see that happen on your spreadsheet. The same applies to construction. If you're doing renovations, you may decide that all of your renovations are going to be done at month 16. So I want to see that breakdown. What is going to happen at month 17 when all of the renovations completed? And I also want to see what's happening on a month-to-month basis with your vacancies during the renovations, because obviously those are going to be bumped up. If the vacancy for the market is, let's say, 10%, but you're going through the renovations, then you have to keep that probably as high as 20% due to the units turnover during the extensive renovation. So I would like to see that on the underwriting. And then looking at the quantitative research, I want to make sure that all of the numbers are telling me a full picture. So it's not just cash on cash 8% or IRR, 18%. All of them combined tell you a full picture. You shouldn't be looking at one of them individually. And I happen to write articles about that as well. So for anyone interested, I can send those articles of how I view that and how I review that as well.
Can you explain what a capital event is? Just if people don't understand that.
Absolutely, yeah. Thanks for the question. Capital event. So potentially, if we've done extensive renovations to the property and its value had appreciated over time, we're at the point where we may decide to go back to the bank and do a cash out refinance. So in other words, we would pull some equity out, and guess where that equity goes if we pull it out? It goes back to the investors. Based on your initial pro rata percentage ownership that you invested with us, if we pull an equity out, let's say everyone gets 30% back. If you put 100,000, you're getting 30,000. Not that you're just getting 30,000 back, you're also getting this 30,000 back tax-free. It's because, again, it's not a taxable transaction. You're getting portion of your principal back. Where in Wall Street would you get something like that? This is like unheard of.
No, it's great. Yeah, the conservative underwriting is a great thing. I was talking to another underwriter yesterday, and when he looks at a deal, he just takes out the rent increases.
Sure.
And just runs the model that way, which is very simplified, but it makes perfect sense because the whole rent model with anything in this value add industry, a value add concept through real estate is just, you're making it nicer and you're increasing the rent. And the thing is that if you can take out those rent increases, so when you buy it, if something happens, you have a pullback. recession, whatever it might be, the thing will still cash flow. It'll still, you can maintain occupancy. You can do all this and it'll still, you're still paying bills. And if you have to hold off your business plan a little bit. So, well, that's great. So you host 2 meetups in New York and New Jersey. Is that one of the primary ways that you find investors or kind of build your whole investor base from the Northeast since it's so difficult to invest?
Yeah, so I started Meetup with sole purpose of helping people locally, and that would be regardless whether they wanted to be active or passive investors. These are not my primary source of investors, although I do get investors from the Meetups nowadays, but a majority of the people come either through referrals or repeat customers for me, for the most part. In terms of the meetups, people get tremendous value from them, and the feedback that I've been getting, especially from my New Jersey meetup, because the frequency it happens a lot more often than New York one. The feedback is exponentially great. People are very thankful, and I even had one member move away for job to another state, and he said that whenever he's going to be coming to visit his relatives, he'll try to overlap it with the meetup time because he's been enjoying our group so much. So yeah, and I'm really happy that it brings so much value to others.
Yeah, local meetups are a great way of learning and just networking with people that, even if they're not active yet or they're not involved with it in one way or another, that you're dealing with people that are involved with it. And
right.
It's great reading and doing listen to podcasts and all this, but when you're actually speaking to someone and you're making that connection, it's awesome. So I can't stress
Absolutely.
that enough. So when we have some syndicators that listen, and it's always, we have people that want to build a bond with their investors, and you're very hands-on when you're working
right.
with your investors.
Yeah.
Explain how that differs, because you sometimes speak to other operators, and I've invested passively before. And you're like, well, I wish I could, I could hear more often from them, or I wish I could get this from them. How is it different when you are working with an investor versus the normal sponsor that you don't hear from?
Absolutely. It's when you look at the typical sponsor, it's someone who has many different responsibilities, and if the team only has so many partners, if it's 1 or 2, they have to handle all these responsibilities. So when people like myself come in that specifically concentrate on being the investor liaison, our sole purpose is to build a relationship with investors, help them get acclimated with the investing process, help them select the appropriate investment for them, and then work with the operator on the other end whenever they have the deal offering and invite us to join them in. We decide on which offering we want to invest in. So being in that liaison role gives me a much more exposure to the deals out there, and another spectrum gives me a much greater exposure to the investors, and that keeps me much closer to them, because that's what I concentrate the majority of my time. Obviously, I do my own underwriting, evaluations, looking at the deals, some of the asset management tasks as well. But again, majority of my time is spent as being an investor liaison, and not wear many of those hats that the typical operators have to wear.
Yeah. It's amazing how many people I've spoken to, and I was at a conference a few months back, and people, they raise their hands. How many people get emails from syndicators? A lot of people raise their hand. How many people wish that they could get more in contact with their sponsor on deals they've done? And it was like the majority of them raised their hand. And it's funny that you've invested with someone, these groups will have multiple offerings come out per year, and they don't even handle their current investors.
Sure.
So it's just amazing how that works. But other than reading books and maybe going to the meetups, are there any other tips or advice that you would offer to someone that's looking to get involved passively or directly in real estate investing?
Absolutely. I think it's absolutely essential to anyone deciding to invest in real estate, in addition to education, is to work on their self-development, because personal development is essential part of becoming an investor. When you're doing something new, regardless whether it's real estate or maybe trading bonds, stocks, or ETFs, or whatever else you decide to do, or buying other things. You have to be open-minded. You have to be open to the opportunity. And a lot of people have that closed mind. They're just afraid to take the first step. And that's simply because how we were programmed, how we're educated. I think our school system don't spend enough time on educating children on and preparing them to the actual financial world. They don't talk enough about loans, financial well-being, or how to take care of their finances. And so I believe it all starts in school. And because we don't have that proper financial education in school, I think people need to spend more time when they're young adults, and or even after they are young adults, even not millennials, baby boomers, Gen X, everyone, they need to spend some time on working on their self-improvement and self-education, because it helps them to open up the doors to those opportunities that are available to them. They just don't see them because they're so close-minded. And I was in the same boat myself, and until I spent some time on reading books like Miracle Morning or The Richest Man in Babylon or Rich Dad Poor Dad, I was in the same boat. I was afraid to take the steps. I was afraid to look at anything. It's just a way of life that we all have, and we need to change that. But that, in addition to educating yourself, you do need to understand how self-storage works, how the market works, the demographics, the recession time. That also is essential part of the education, and that comes through books, podcasts, and extensive networking with others.
It's amazing. People probably, for the most part, I think, don't look into their financials until maybe they're in their early 20s or so, out of college, and they say, I got a bunch of student debt, I've got a car loan.
Yeah.
Wow, and it's so easy to acquire debt that goes down in value, or that doesn't make you money compared to buying real estate or something like this. So it's a completely different mindset. So you're 100% correct. So Alina, how can people learn more about your meetups? And I'll put all the links in the bottom, yourself and your meetups.
Sure. So my website is samofinancial.com. I'm available on LinkedIn, Facebook, Instagram, Bigger Pockets. In terms of the meetups, they're both on meetup.com. They're called Power of Passive Investing. One says New York, one says New Jersey. Everyone is welcome to join us or reach out to me with any questions. I'm more than happy to help out.
Okay. Well, it's awesome. Well, thank you very much for being on the show today. And I look forward to speaking to you in the future. And if anybody else also, what we're doing is I'm doing a 15-minute call. So if anybody has any questions and wants to set up a strategy call with myself, you can click the link below and do that. But Alina, thank you very much for your time, and I'll speak to you soon.
Thank you, Charles. It's a pleasure to be here.
Thank you. Bye-bye. Hi, guys. This is Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in investing in real estate and you don't know where to begin, set up a free 15-minute strategy call with me at schedulecharles.com. That's schedulecharles.com.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Harborside Partners Incorporated exclusively.